So now the idea of capital gain tax. Please confirm that you can hear me.
I can hear you, sir.
Okay, that's fine. So the idea of capital gain tax is actually from the disposal of non-current assets. So the idea of capital gain tax came because there was disposal of non-current assets, and because there was disposal of non-current assets, there's need for the tax authority to also look for a way of getting more income from the disposal of assets, because in a way, when you dispose an asset, then the proceeds from the disposal of assets becomes a tax base, right? So there's need for the tax authority then to use that avenue to gather more income from the sale of assets. So capital gain tax is a tax on non-current assets, right? So that is just the brief uh, definition, or if you would, there is no specific definition, but if you would allow me to talk about it, that would just be what capital gain tax is. And the idea of capital gain tax is that it helps to then broaden the tax net, or bring a lot of assets into the tax net of the tax authority, right? And administration. So let's move on to look at the administration of capital gain tax. Of course, in the case of disposal of assets, right? Are we on the same page? In the case of disposal of assets, you could have two different players. You could have corporate organizations, and at the same time, you could have individuals, right? For the corporate organizations, the tax administration will be Federal Inland Revenue Service, FIRS, and the major body of law that guides is section 54, of Company Income Tax Act. And for individuals, it will be actually administered by the State Internal Revenue Service, right? And the major code of law that guides this is section 53 of Personal Income Tax Act of Peter. Are we clear to this extent? Then let's now look at the basis of assessment, or what you would like to call year of assessment. It is important for us to note that the year of assessment will be on actual year basis. So that will be the tax will be on actual year basis, and that simply means from 1st of January to 31st December of the same year. Is that clear to everyone, please?
Yes, sir.
Now, let's look at what is the effect of Finance Act on Finance Act We said that for the sake of this class, what Finance Act does is that it amends the existing tax laws, right? So now I want to look at what are the basic amendments that the Finance Act has done to Capital Gain Tax Act, right? So the first amendment is that Finance Act 2019 says that compensation for loss of office below 10 million is exempted from Capital Gain Tax Act. So from Capital Gain Tax. Is that clear?
Yes, sir.
Are we on the same page, please?
Yes, sir. Yes, sir.
Good. Now, that is the major amendment that Finance Act 2019 has on the tax law. So let me look at what is then the provision of Finance Act 2020 and how it affects capital gain tax. So what Finance Act 2020 says is that the compensation for loss of office up to 10 million should be exempted, just like we said, right? But then what this is now saying that the excess of that 10 million, the excess of 10 million should be deducted by the taxpayer and remitted within the time. Okay, sorry. And remitted within the time applied. Sorry, time specified on the pay as you earn scheme. So what this is basically saying is that at every point where you have something, let's say you have compensation for loss of office that is 20 million, 10 million will be exempted, then capital gain tax should be computed on the balance of the 10 million, and then you remit the tax liability or you remit the capital gain tax uh, alongside when you remit your payee. Is that clear to your place?
Sir, can you come again on that figure, sir?
So what I was saying basically is that let's put figure to this. Let's say you have 20 million. So the first 10 million is still exempted, right? But the next 10 million, then there will be need for you to compute capital gain tax on it. And after you compute capital gain tax on it, you remit the capital gain tax alongside or based on the deadline for payee. And you know the deadline for pay is on the 10th of the month, the 10th of the subsequent month. That's the deadline for pay as you earn. So you have to remit such capital gain tax before the next pay deadline under the regulations of pay as you earn scheme. Do you understand that now?
Yes, sir. Thank you, sir.
Yeah. So let's look at what is then the effect of capital gain tax. I'm sorry, Finance Act 2021. The effect of Finance Act 2021 is that sales of securities, sorry, let me use shares. Sales of shares or Nigerian government securities, sorry, Nigerian government securities, that's specifically for Nigerian government now. That's either Nigerian government shares or Nigerian government securities shall be exempted from capital gain tax. Is this clear enough? So if you are buying shares in Nigerian government companies, Nigerian corporations, or you are buying securities, it could be bonds, treasury bills, etc. The sales of such instruments will not suffer capital gain tax. Is that clear? Hello?
Yes, sir. It is very clear, sir. You can continue, sir.
Okay. So that's basically one of the provisions of Finance Act 2021 and the most recent Finance Act 2023. Finance Act 2023 says that cryptocurrency transactions, that's crypto trading. Yeah. Hello? Ah, please, can you hear me?
Yes, I can hear
Yes,
you,
sir.
sir.
Yes, sir. Very well. Very clear. Very
So
clear.
the most recent is that capital cryptocurrency trading, that's crypto trading, will suffer capital gain tax. Sorry, just a minute. Just a minute, I'll be right back. 1 minute. So are we still together, please? Hello,
Yes,
can
sir. Yes,
okay,
sir.
good.
Yes, sir.
So we said cryptocurrency trading will suffer capital gain tax. So that's basically it. All right, that's fine. So that's basically the provisions of Finance Act 2023. So now with this, we've looked at the effect of the Finance Act or the amendment the Finance Act is making on the Capital Gain Tax Act. So let's then move in to looking at what are the allowable deductions under the Capital Gain Tax Act. Because, at the end of the day, what we'll still be doing will be for us to compute capital gain tax, right? So what are the allowable deductions when it comes to capital gain tax? Or before I go to allowable deductions, let me look at what are the items that are going to suffer capital gain tax. So let's look at the items that would suffer capital gain tax. Number one, or better put, you could call it chargeable items or chargeable assets, anyone, right? Or gains chargeable, anyone you would want to call. Number one, gains that arise from options, debts, and incorporeal property. Options, debts, and incorporeal properties. Two, we have any currency other than the Nigerian currency. And that was the justification for charging cryptocurrency or crypto tradings to capital gain tax, right? There is any other property, any other tangible or real asset, including motor vehicles, generators, etc. And then we have stocks and shares. Stocks and shares. So those are the items that will suffer capital gain tax. Is that making sense, please?
Yes.
All right.
Hello, sir.
Yes, please.
Please, what is incorporeal properties?
Somebody said, Incorporeal properties are basically intellectual properties or intangible assets.
Okay. Thank you, sir.
Like anything other than the real assets is incorporeal. Sorry. All right. Now, having said that, let's move in straight to then look at one real life scenario that you must take care of under capital gain tax. Now, one thing you must take care of is that where a transaction is conducted between connected persons. Are we on the same page? So now let me give an example of connected persons. Connected persons are persons that an entity is related with. When I mean entity, it could be a corporate organization and it could be an individual. But when I say connected persons, I mean transactions that emanates from connected persons, either they are related by blood, by business relationships, or by adoption. So it could be fictitious and it could be biological. But any transaction that happens within the connected persons shall be deemed, or the proceeds from disposal shall be the fair value. Sorry, let me use the tax term. The market value of such assets. Is that clear enough?
Yes, sir.
So in case for instance, based on the fact that few of you have known me now, but so based on the fact that few of you have known me now, if you want to transact with me, there might be some concession, right? There might be some concession. Let's say, for instance, you want to sell to me your assets, then in that case, you might have some concession based on the fact that you've known me before or we've met before. In that case, then the tax authority is saying that where there is a relationship that subsists between such persons, then you should consider the transaction to be as arm's length. An example is where we have persons sharing the same board with two entities, like two entities are having similar directors. So in that case, so those entities are having um, those transactions between such entity will be deemed to be at arm's length. So you will conduct such transactions at arm's length. Is that fair enough? Hello.
We are with you, sir.
Then the
Well,
next
We are with you, sir.
good. Then the next thing you
We
have
are
to
with
look
you.
at is when is the date of transaction? When is the date of transaction? Now, where a contract is performed, the day of transaction will be the date in which all conditions attached to that contract is performed. Do you understand? The date in which the obligation is performed or the transaction is conducted, or the date in which all conditions attached to such contract is conducted, will be the date at which you consider such asset to be subjected to capital gain tax. Is that fair? Good. So let's look at one question. Move on. But before then, let's look at a basic format for it. At least the simple one first. So determination of capital gain tax. You have sales proceeds. Less incidental cost to sell. And this includes commission, uh, agency fee, any cost to sell, basically. You have this. Then you have less cost of acquisition, or acquisition cost as you would want to call it, then any cost of improvement of the assets, improvement of assets, or any cost incurred on the asset. So the two costs will be deducted, and then you have your capital gain. When you deduct it, you have your capital gain, right? Then you have capital gain tax at 10%. And then you have this. Any question, please?
Very clear, sir.
Good. So that's basically how to determine your capital gain tax. But the possibility that you follow this format in the exam is 1/10. The possibility, because this is too simple for you to say you want to be a C. But we'll just look at the next modalities to it. So let's look at the first transaction we want to consider now is hire purchase transaction. Hire purchase transactions. So for the sake of hire purchase transaction, the idea for hire purchase transaction, are we together, please?
Yes, sir.
Now, one thing we want to note here is that for hire purchase transaction, the cost of the asset, is the cash price of such assets. So we would not take cognizance of the interest. Are we on the same page? We will not take
Yes, sir.
cognizance of the interest. So because the interest are allowable deductions, so if we should take cognizance of that interest, it will be like you are enjoying twice. It will be like a double enjoyment. You understand? So in determining capital gain tax, we will only take into consideration the cash price and then ignore the interest element. Then the question would be, how do we determine the cash price and the interest element? So I want to solve a question now. Let me solve a question. At any time my screen comes up, just confirm that you can see my screen. I'm not talking about the whiteboard now. I'm talking about the I don't know if we could uh do we used to be available for classes in February. I mean, I said in February, in November.
Yes.
First week in November, right?
Yes.
So we can have a broad revision. So I can actually be able to, with that, I'll be able to dot my T's, to dot my I's and cross my T's, and then commit it to the hand of God. Sorry, my this trying to say. Sorry, just a minute. Trying to open. Okay, good. I forgot. Confirm that you can see my screen now, please.
Not yet.
Now?
Okay, it's coming up. Okay, yes, it's on now.
Okay. So we have, what do we have now? Apex, right? All right, so let's go ahead. We were told that Union Company Limited purchased the chargeable asset on hire purchase, right? The deposits paid for the purchase is 250,000 naira, right? The balance of the purchase price was to be paid in 36 equal installments of 25,000. The cash price of the asset is 790. Calculate the capital gain tax due, assuming the assets were sold for 1.25 million after payment of 24 installments and for 1.3 million after full payment of the installment. So the first thing will be for us. Are we on the same page? To do our
Yes,
work.
Royalty.
Go on, sir.
Determine. Hey, have I stopped recording?
The record is still on.
Okay, good. So determination of interest, that's the first way to go about it. Determination of interest on hire purchase. Right?
Okay.
So you have your Naira sign now. So you have the cash price. How much is the cash price? If you were to pay for that asset in cash, you would have paid how much? Hello?
Hello.
790.
The screen.
Less, if you are paying 24 installments, right?
Okay.
That's the cost of the asset. The cost of the asset is what? The cash price of the asset is 790. Now, your initial deposit is how much?
That's
Initial deposit
250.
is
250.
250,000, right? Then annual installment. The first illustration we have is that he's paying 25,000 for 24 times, Abby?
36 times, Abi.
No, for 1.2 after 24 installments. That's the whole idea, right? Are we together?
Yes.
Okay, is to pay how many installments? Sorry. The balance of the purchase price was paid in 36 monthly installments. Sorry, it should be 36 first for my workings. So how much will that be in reality? That's 25 times 36, Abi? And that's 900, right? So when you add 900
Mama, give this man lighter now.
plus 250, you have 1150, Abi? Then the interest portion please mute your mic, will be 1150 minus 790. Hello, Samsung, mute your mic. All right. So it means this is the total interest element I was going to pay. That's 360,000, right? So it means monthly installment now. I mean monthly interest, sorry, will be 360,000 divided by the period of installment, and which is 36 months, and that give you 10,000 naira. So that is the interest portion of the contract. Is that clear enough, please? So now let's go ahead and now solve the question. And the question is determination of determination of capital gain tax. And the first scenario is after 24 months. So after 24 months, the sales proceeds is how much? How much did he sell the asset? He sold the asset for 1,250, right? Are we on the same page?
Yes.
Then less cost of acquisition. Okay. The interest, we did the cash price of 790,000, and the initial payment he made was 250,000, and the annual installment he was supposed to pay is 25,000 monthly. So you have 25,000 times the period of higher purchase, that's 36. So 25,000 times 36 gives you 900. So when you deduct 150 from 790, sorry, you have 360. So that's the total interest portion of the contract. And when you divide this by the number of months, you have the monthly interest charges of 10,000. Right? So initial deposit now is how much? Good. Initial deposit is how much? 250,000. Add monthly installment, right?
Okay.
And the monthly installment in this instance is he paid 25,000, right? For 25 months, right? 24 months. And when you do that, you have 25 times 24. So you have 600, right? less interest portion. So you still deduct the interest portion, or let me use deduct so it will be less. Deduct interest. So what's the interest now? The interest is going to be 10,000 times 25. Sorry, 24. Why am I saying 25? So you have 240, right? So it means for this you will have 250 plus 600 minus 240. That's 610, right? So it means you have
Yes.
capital gain. The capital gain will be 1250 minus 610. That's 640. Then you have capital gain tax at 10%, Abby? And that gives you 10% of 640. That's 64. That's the first scenario. Does that make sense to you?
Yes.
Can we go ahead?
Yes.
So let's solve the second issue. For 1 point, if you're selling it for 1.3 after the total installment, Abby? Determination after the total payment is paid. So you have sales proceeds. How much did you sell it? 1.3, Abby? Less acquisition cost. So what's the acquisition cost here? Initial deposit, right? And the initial deposit is how much? 250. Am I alone?
Now,
Add monthly installment. But in this case, he has completed the installment. So he's paying 25,000 times how much?
900.
Is it 34, 36?
36.
Thank you. So you have 25 times 36. That's 900. And then you deduct the interest portion. How much is the interest portion? And that's 10 times 36, have you?
Yes.
That's 360. So if you do that, you have 250 plus 900 minus 360. And that gives you 790, Abi. So capital gain is how much? 13 minus 790. And then you have capital gain tax, CGT at 10%. That gives you what? Is that very clear to you?
Yes.
Any question? Any question? So in the absence of questions, let's then move to looking at partial disposal. Do you all understand what we've done so far?
Yes.
Yes.
Yes, sir.
partial disposal. And for partial disposal, basically, the idea is that it is possible that you have a very large asset and you want to sell just a very small portion of that asset, right? Is that possible that, let's say for instance, you have a duplex and you have 2 wings of duplex on 600 square meter of land. Then you now decide that you want to sell 1 wing of duplex and then stay on the other, right? Now, you want to sell it, don't forget that you didn't just buy 1 wing. You didn't buy one each wing separately, right? So then there's need for us to now determine what is the cost of acquisition of the asset you dispose. That's the issue. What is the cost of acquisition of the asset you dispose? For the sales proceeds, we don't really have any issue. But our major issue is how to determine the cost of the one you are selling, because you sold it you bought it alongside other assets and you didn't buy it as a unit. Do you understand? And for you to be able to solve that kind of problem, to determine the cost of acquisition, your cost of acquisition would be A over A plus B. Are we together?
Yes.
Are we together, please?
Yes.
So what is A and what is B? So A is the sales proceeds from the asset disposed, and B is the market value of the undisposed asset. Are we on the same page? Are we on the same page? So that's basically how to do it. So when the answer you get here will be multiplied by the cost of acquisition of the total assets. Okay, let me just do A over A times B, A plus B times C, so that it will make more sense to you. Let's see. Right, and C. The cost of acquisition of the asset. Is that clear? Is that clear a little bit, please? Do you understand this idea, or I need to come again at one point?
It's clear.
Please let's go over it again.
Okay. We said when you are selling an asset, then when you are selling a fraction of your asset, then we say it is called partial disposal. And our major issue will be that we didn't know how much you bought that particular asset you are selling. We didn't know the amount you bought it, right? Because we didn't know the amount you bought it, so the only thing we can do for you is to apportion the amount by saying how much did you buy? How much are you selling the asset? And how much is the remaining part you are not selling? And how much did you buy it? So the part you are selling, the amount you are selling is the A. The market value of the amount of the portion you are not selling is the B. And the C is the cost of acquisition of the whole asset at the time you bought it. Do you understand now?
Okay.
All right, so let's move on to solving an illustration. Then, well, after solving this illustration, we'll then be looking at past questions. Okay, before I do that, let me just look at rollover relief once and for all. Rollover relief, so that I will just treat everything once and for all. But do you understand all this to a large extent?
Yeah.
Now, I can rub up my board, Abby. For the rollover relief, rollover relief actually occurs when you decide to invest proceeds in the disposal of the asset. Are we on the same page? When you decide to invest the proceeds from the disposal of the asset, you have to note that for a taxpayer to qualify for rollover relief, he must dispose such asset. The proceeds from disposal of such asset must be used to acquire an asset of the same class and for the same purpose. So if you are using it for profit making, invariably, subsequently, any asset you are buying must be used for similar trade for profit purpose. So if it's not for it, you can't buy, you can't sell tractor and then go and buy Benz. It's not, tractor is for farm, while your Benz is for just your luxury. That's not, you will not enjoy rollover relief. Do you understand? So number one, for you to qualify for rollover relief, it must be used for same purpose for which the previous asset is used for. Do you understand?
Okay.
And number two, they must be within the same class. One, for a taxpayer to enjoy, it must be within the same class of assets. And number two, it must be for same purpose. All right, as the old asset. So now we then need to do roll over relief. So the proceeds you get when you invest such proceeds will be a determinant for reduction in your how do I put it now? Will be used to reduce your capital gain. And once it is reducing your capital gain, then invariably your capital gain tax is likely going to reduce. And when are we together?
Yes.
Where
Yes, sir.
a taxpayer will no longer pay tax as a result of investment, then you say it is a full rollover relief. In our illustration, I will explain better with figures. But where a taxpayer will still pay some portion of the of capital gain tax, then you say it's partial rollover relief. And where a taxpayer does not even enjoy any rollover, you say there's no relief. And that only occurs if it is not within the same class of assets, or if it is not for the same purpose, then there will be no relief. So there are three instances: you have full relief, you have partial relief, and you have no relief. Is that fair for everybody?
Okay.
Any question? So in the absence of question, let's quickly solve this together. Is this the whiteboard you are saying?
This is a
No.
blackboard.
Right. So let's go ahead.
Okay, we can see it now.
So I would have said the lady should read for us so that we will not sleep. But at this time like this, the lady should not read. The man should read so that at least the masculine voice will wake us up. Because a lot of us are tired of the story itself. Let's go ahead. Please read. Hello. Hello.
I read.
Yes, a volunteer should please read.
Okay. Okay. Best Manufacturing Nigeria Limited is engaged in the production of building material in Ota, Ogun State. Due to sudden power surge at night, one of the two factories got burned before the firefighters arrived the scene. The factory were comprehensively insured with Macon Insurance Company PLC. Can you hear me, sir?
I can hear you. Please go ahead.
The management decided to move the factory from Ota to Lagos State. Concerted efforts were made to acquire land for a new factory and the factory in Ota that was not burnt formed part of the cost of that was not burnt, which cost 1,800,000 6 years earlier. Was sold for 4,200,000 in March 2007.
So let's quickly analyze this. So it appears to me that I'm having two different assets here. There's one that was burnt, and there's one that was not burnt. Do you understand? So
Yeah,
the one that was not burnt was sold. Do you understand? So the examiner has shifted our attention from the one that was burnt to the one that was not burnt. So the one that was not burnt was sold for 4.2 million naira. I hope that is clear enough.
Yes.
Oh yeah, let's go ahead. Please go ahead.
Okay. The amount formed part of the cost of construction of the new factory at Ijegbo, which was completed in November 2007 at a cost of 5,600,000.
So it means that, hello, hold on, sir. Thank you for your patience. So it means that the one that was, the one that was not burnt, the money they got from that, they used to build a similar asset. Remember, it was factory that was burnt. It was factory they were selling, and it's factory they are buying. Abi? So,
yeah,
and it is for the same purpose. That's why it qualifies for rollover relief.
Okay.
Do you understand? It was the same factory that got burnt that they were trying to build in another location. So it's the same class of asset and it is for same purpose, right? Please go ahead.
Okay. In 2008, for the Ota factory costing 3,700,000, the insurance company paid 5,900,000 to the Best Manufacturing Nigeria Limited. Out of the compensation received, 4,600,000 was spent on the construction of the new factory in Ijegbo, while the balance was put in a fixed deposit account, which yields interest. Best Manufacturing Nigeria Limited has just appointed you as a company tax consultant required. Advise the management on the capital gain, if any, arising from the event. B, the capital gain tax payable. C, how the company can reduce the capital gain tax payable.
All right. Very simple, Abi. So somebody just reminded me after posting today that I still promise you on Petroleum Industry Act, Abi.
Yes, sir.
No
It's very
problem.
important.
I understand. I know the importance myself. So no problem. We will cover for it. Don't worry. So I will solve this question today. I understand you have case study by 9, Abi. By what time?
9.
By 9, okay. So I will try to round up by 8:30, before 8:30, so that you can go for the class. So it means in my next class, if I'm unable to round up capital gain tax, I'll do that in my next class and then quickly solve an additional question on petroleum industry act and petroleum profit tax. Then that will be it. And then I understand that you've done double taxation already, right?
Yep.
Okay. So no problem.
Sir.
But the theoretical aspect, sir.
Okay, it's only the theoretical aspect you did. Okay, no problem. I will find a way around it. Don't worry. Yes, it's part of the PPT, this thing. It's part of the PIA issues. Now, so we have two different assets here. We have first the one that was burnt and the one that was not burnt. So we have to identify, let's do them one after the other. What's the name of the asset that was burnt? Ota factory, Abi. Determination of capital gain tax. On the burnt factory, Abi. Now, where an asset is under insurance and the asset got damaged, the claims received shall be deemed to be the sales proceeds of the asset. Do you understand?
Perfectly, sir.
Good. So let's go to compensation or received. Let me just put compensation received or claims. How much is the claim? 5.9, Abi. Right? deduct cost of acquisition. Abi? So the Ota factory was costing how much?
Costing 3.7 million.
3.7 million. Abi?
Yes.
Was there any cost that related to purchasing the asset at the time they bought it? No. Abi? So we have
1.8.
No,
There
it's
is a
the bond part.
where is that?
That part was not. We
No,
are
no, no.
dealing
That
with the
part.
bond.
No, that
That
part
one
was
was
not
not.
burnt. That part was not burnt. We are only looking at the burnt part now. Do you understand? We are still looking at the burnt part. We're looking at total factory alone, Abi. So how much do we have now?
Yes.
So ideally, 2,200 would have been the capital gain tax, right?
Yeah. Yes.
Do you understand?
Yeah.
Deduct.
Please, sorry, how do we come about this 3.7?
They said that the factory was costing 3.7 million.
2008.
Yes. This now
What
highlighted
about the
it.
1.8?
The
What about the
1.8
1.8?
the 1.8 was relating to another asset. There are two
Okay.
factories they're talking about. They said there's one in Ejigbo that was not burnt, which cost 1.8 million. That's the cost of the one that was not burnt. Do you understand?
Okay. I thought that's the one that was burnt.
No. They said which was not burnt, which cost
Is it not
1.8.
Ejigbo that is the new site? From the beginning, the factory
Yes.
was set up in Ota,
Yes.
and then it got burnt, and then they relocated to Lagos, which is now
Yes.
Ejigbo.
Exactly.
So it is the Ota factory that cost the 1.8. It is the Ota factory that got burnt, and that's what cost 1.8.
No. You are
All
mixing
the
it up.
three factories are Ota factories. It is.
Are you here?
I'm with you, sir.
No, let's read this English together. They said concerted efforts were made to acquire land for a new factory in Ejigbo. And the factory in Ota that was not burnt. I was explaining that they have two factories. Possibly the two of factories are in Ota. Do you understand? Now, they said they have two factories. There's one that was burnt, that was under insurance. There's one that was not burnt, that cost 1.8 million. Do you understand?
Yes, sir.
Is it clear, please? So deduct rollover relief. And how do you determine your rollover relief? It is lower of sales proceeds. How much is the sales proceeds?
That's 5.9.
Or amount reinvested. How much is the amount reinvested?
4.6.
So you invested 4.6. So you are picking whichever is what? Is lower. So here 4.6 is lower, right? Then let's cost of acquisition. How much is the cost of acquisition of that asset? 3,700. Do you understand? So it means the amount that will be rolled over will be 4,600 minus 3,700. So that's 900. In this case, you say because this 900 is lower than this, then there is a partial rollover relief. And so that's why I was saying it's better for me to use figure to explain it. Partial rollover relief occurs when the amount reinvested is lower than the sales proceeds of the asset.
Okay.
Do you understand? Partial relief will occur when the should I come again? I'm coming again already, sir. It will occur when the sales proceeds, the amount you invested is lower than the sales proceeds of the asset. So now you have capital gain. So capital gain is 2,200 minus 900. And then you have capital gain tax at 10%. And that's how much?
1.3. That's 30.
So that we've solved the factory that got burnt. Now let's go and solve for the factory that is not burnt. Determination of capital gain tax on the factory that is not burnt, Abby?
Yes.
Yeah. Let's just put, it is also at a factory, Abby?
Yes.
Yeah. So here, we have sales proceeds. How much is the sales proceeds? It was sold for 4,200, right?
Yes.
Then how much did he buy that asset?
1.8.
Did he incur any cost again to either sell or buy? No, Abby?
Yes.
You have 1.8 million, right? So now the net amount you have is 4,200 minus 1,800. So you have 2,400, Abby. But he invested, Abby. Let's roll over relief, and which is going to be lower of the sales proceeds, right? Sales proceeds is how much? 4.2.
4.2.
Or amount reinvested. How much is the amount reinvested?
Same 4.2.
He deducted your 4. Is invested to 4.2.
But
No, he invested 5.6 now.
but they said the amount form part of the construction of the new factory, which costs 5.6.
Yeah, so it is 5.6 he paid for the asset,
Yes.
right?
Okay.
So you are
Yes.
comparing the two. So 4.2 is lower, right?
Yes.
So you bring your 4.2 here, and then you have less cost of acquisition of that asset, Abby.
Yes.
How much is the cost of acquisition? 1.8.
1.8.
So you have 4.2 minus 1.8. And that gives you 2.4, Abby. So you have your capital gain, and this is what? 2,400 minus 2,400. You have 0.00, Abi. So capital gain
Yes.
tax at 10% will be what?
0.
And that is the end of the B part of the question. But in this case, because the amount you invested is higher than the sales proceeds, you say what? It has a full rollover relief, right? Do you understand?
Yes.
Now, they asked us that you should recommend how can they reduce the capital gain tax payable. To reduce the capital gain tax payable, you have to pay 10%. I mean, you should advise him that the amount placed on fixed deposit should have been invested on the new factory. So you should have invested either 5.9 or higher than 5.9 in the new factory. Best manufacturing to reduce the capital gain tax burden. Best manufacturing is advised to invest the whole of 5.9 million, right? Is it 5.9? Yeah. Sales proceeds on the acquisition, on the construction, sorry, of the new factory, so as to enjoy a full over. So if this one was coming, it would have been a 15 marks question, and that's how you would have gotten the whole of the 15 marks. Any question, please? Any question, please?
No question.
So in the absence of question or questions, we have another class on Thursday, right?
Yes.
Yeah, we meet on Thursday, same time, same station.
Sir, before you go, sir,
Yeah, please go ahead.
on a lighter mood, sir, what is the Finance Act provision for as regard Ejibo? Is it Ejibo or Ejebo? What is the Finance Act provision for that?
No, there's no finance act provision for him.
I can see a brother calling Ejebo. Is it Ejebo or Ejibo?
Ejibo. It's not from our side here, so I understand.